Today what we want to do is get into a new topic, which is market risk or price risk. Today we'll define it very quickly, and then we'll get into the measure. The key measure we are going to focus in on is value at risk. We'll do, for the first exam, we'll do some easier value at risk type of problems, some basic ones just to make sure you're comfortable with the math. And then for the second exam, we'll get into more practical, what you actually see in real life, and bring in correlations and other items. But that's our goal for the day, and we'll do a bunch of examples just to give you some practice with the whole concept. Hopefully you've seen this in a previous class or saw it in your statistics class, but if not, we're going to assume you've never seen this before, and we'll build it from scratch. So I'm up to page 21 or somewhere around 21. It's either 20 or 21 or 22, as I add a little bit as we go through the semester. But price risk, market risk. One thing to remember is when we define price risk, interest rate risk was the first risk we talked about. It is my favorite one just because finance really has so many tools they can deal with interest rate risk. But interest rate risk is a special case of price risk. So for most of your banks, for project one, you won't see a section of their annual report talking about interest rate risk. You'll probably see market risk is probably the most common. You might see price risk. You might see interest rate risk as a part of the market risk, or they may talk about bonds or something more related to interest rates. But interest rate risk is a special case. I like to break it out just because banks, insurance companies, and pension plans, interest rate risk is a huge part of the risk they're managing when it comes to market risk. So what is market risk? How do we define it? So and the key here is that you're thinking both sides of the balance sheet. So it's the price of an asset falls, or the price of a liability rises and you lose money, or they don't rise or fall the same amount. So your assets go up 5%. If your liability goes up 15%, you're going to lose a lot of money. Or your assets could fall 10%, but if your liability falls 15%, you might be okay. So the key is the relationship of the two, and assets minus liabilities, that's your net worth, or in the pension world, it's your pension surplus. So that's what we're really protecting when we talk about price risk. So when we looked at the Robert Arnott article, he talked about three risks: pure risk, asset risk, and asset liability risk. When he said asset risk, he's really talking about the price risk or market risk of assets only. Asset liability risk is when you're looking at price risk, but both assets and liabilities. You're looking at both sides. And then a big subcategory of that is the interest rate risk, just because pension liabilities are so sensitive to interest rates. So there's our definition, fairly straightforward. It's pretty simple. Prices rise and fall, and you have assets and liabilities, and you're really just looking to see how the prices rise and fall relative to each other in order to protect your net worth. So you can see when we did the balance sheet immunization using swaps, we were really managing the market risk, the price risk, specifically related to changes in interest rates. So now we get to the measure. So how do you measure price risk? There's a lot of common measures. Standard deviation is a common measure. We usually think about standard deviation as being total risk. Hopefully you remember the formula for standard deviation. It's a very simple formula. If you remember, just think back through it. You take x sub I minus x bar. X bar is the mean or the average of a distribution. Xi is the individual data points. I'll actually show you this when we do it. I'll do something in Excel and show you how to do those. So you take xi minus x bar. We then, very, very important, we are then going to square those. So when you square them, what happens when you square them? When all the negative numbers disappear. So if you're looking at January versus the average of the last 10 years, so maybe you have January 10 years ago, and you're looking at the monthly average for the last 120 months, last 10 years. If January is below average, you'll get a negative number, but when you square it, the negatives disappear, and that's pretty important. So there's a few things that we assume here. The first assumption is symmetry. We're assuming when you're above the average and below the average, that's really nice and symmetrical. There's nothing wild going on in the tails, and we'll look at that when we look at certain markets. But that's key. That's what standard deviation is telling us. How far are you from the average? And remember, another word for the average, which I don't like this term, but we use it a lot, and I think it tells you a lot about finance and how we manage risk. You'll often hear the average or the mean referred to as the expected value. And we talked about that early in the semester where we're looking at deal or no deal. I calculated the expected value, even though it was absolutely impossible for her to ever get the expected value. She was going to get one of the dollar amounts, whatever box she had, or the bank offer. I mean, the only way she'd get the expected value is somehow in a later round, the bank offered that expected value. That'd be pretty just complete random chance. So expected value, what we really mean by expected value is 50% of the time we expect to be higher than that, and 50% of the time we expect to be lower than that if the distribution is symmetrical. If you go back to that deal or no deal, 2/3 of the values were well below the bank offer. 2 of the values were above the bank offer, and 4 of the scenarios, 4 of the boxes were below the average or expected value. 2 were above, so it was very skewed. So you have to look at that. This is not the median. So if the median equals the mean, then yeah, 50% of the time you'd be above that and 50% below that. There are skewing measures in Excel. A simple thing to do is just compare the median to the mean, and if they're radically different, then you probably don't have a symmetrical distribution. And so what we're looking for standard deviation is how far do we get from the expected value. That's how we define risk in finance. It does not make sense to most people. Most people don't think about risk as how far from the average are you. Most people think about risk as far in terms of how negative can you be. So, if your average is 8%, or let's say your average is 1%, but you have a month where you're up 10%, and you say, wow, this is really risky. You're up 10%, and your average month is only 1%. So, wow, you're really far from that mean. Someone's going to say, yeah, but you're up 10%. But in finance, we assume, hey, if you can be up 10% when your average is 1, then you can be down 9% when your average is 1, or down 8% or whatever, the math make it symmetrical. And so, yeah, so if you can be up 10, if you can be 9% above your average, you could also be 9% below your average. So we just assume there's that symmetry between the two. There is something called semivariance. And I remember reading an article by a guy named Brian Rahm. I think he's still around. I don't know if he's still selling his software package. But we're going to do, in Project 2, we're going to do an efficient frontier. And in the efficient frontier, we are going to use standard deviation as our measure of risk. But Brian Rahm, he said, no, a better measure of risk is semivariance. What semivariance does is essentially standard deviation, but it only looks at the x of i's that are below average. It ignores the ones above average. And in fact, if you go back to Markowitz, Harry Markowitz is the one who developed the efficient frontier, the model we'll be using in Project 2. And even Harry Markowitz admitted that semivariance might have been a better measure. But you have to remember, back in the 1950s when he was doing this, they did not have computers, they didn't have calculators. So calculating standard deviation back then was in fact, I really marvel at what they did back then. They must have had a bunch of PhD students just cranking things out on slide rules pretty amazingly. So semivariance is another way of looking at it. There's a lot of debate. There was actually in the Financial Analyst Journal a debate month after month between Brian Rahm and Roger Ibbotson on this whole debate about which is the better measure of risk. But anyway, you take You take the differences, you square them. You then divide that by n, so you get the average. And then you take all of that and you take the square root. You raise it to the half power. That's your standard deviation. So what we're looking at is the average difference from the mean. We square it so it's always a positive number. So we're not letting the negatives and positives offset each other. And we're not just looking at the negatives with semivariance, but we're looking at how far can you be from the mean. We're going to square it so outliers will be exaggerated. That's another thing with standard deviation, is it tends to emphasize outliers. And then you square that, you take the average of all of that, take the square root of that, and that gives you a standard deviation. If you have a normal curve, then the standard deviation tells you a tremendous amount of information, and we'll look at the normal curve. This should all come back to you from your stats class. Hopefully you remember all of this, but if not, I'm going to teach it to you all over again just in case you've forgotten it. And the actuaries in the room, we do have some actuarial science majors. They can probably teach us some other techniques that would be also effective. I had one actuarial major, science major, do an analysis of something called extreme value theory. You might look that up. And it's actuaries. If you think about an actuary, they're dealing in the very, very, very end of the tail of a distribution. The things that actuaries insure and insurance companies are things that happen very infrequently. It's a very serious car accident. It's a 1 in 200 year earthquake or hurricane. It's life insurance. It's someone 30 years old dying prematurely, which happens very infrequently. So extreme value theory, what it looks at is it's really focused on those tail events, those things that don't happen very often, but when they happen, boy, they're really extreme. I talked to some mathematicians and actuaries about extreme value theory, about applications, say, to insurance. They didn't seem too thrilled about it. It's pretty complex math, but there are other theories out there. So we're using standard deviation for our purposes as part of value at risk. You'll see how we're going to incorporate standard deviation as part of value at risk. But that's one definition. So remember that. So I'll show you this formula again. You can pause if you want to take a picture, but hopefully you remember the formula. It's a very easy formula. Beta is another measure of risk that you learned in earlier finance classes. We're actually not going to use beta much in this class. We'll hit it a little bit in the project just to bring it in because it's commonly brought into that type of analysis. But we're not focusing in on beta much in this class. I'm assuming you've had that, you're an expert on that. The formula for beta looks a lot like the formula for standard deviation. But our focus is going to be on value at risk. So value at risk is the measure of the amount of loss expected at some given probability. I'm going to also refer to that given probability as risk tolerance. There's other ways of stating it, but some people say at our risk tolerance, at our probability. The value risk can be calculated 3 ways. Parametric, we talked about this a little earlier. Parametric value at risk, historical value at risk, and stochastic value at risk. I've used all 3 of them. Stochastic is the most sophisticated, and usually people think, wow, if we use stochastic, we're really doing a great job. We're measuring risk better than anybody else. Stochastic, yeah, it's simulation, it's complex formulas. You've got to get correlation matrices and averages and everything to line up. Quite complex, but they're only as good as the assumptions put into them. We will not be using stochastic VAR in this class. One of these classes I'll have to build a stochastic model using Excel. At UTSA, we had a few stochastic models that vendors would build for us, and we run our analysis through those. The actuaries use stochastic value at risk models for catastrophes. They use models built by 2 firms, RMS and AIR. RMS was mainly started off for building catastrophe models, simulation models for earthquakes, and AIR, just like it sounds like, AIR, they built models for hurricanes. But now both firms do everything, even terrorism risk and probably COVID-19. They do every kind of risk you can think of that you can model using stochastic analysis. For the actuaries on the property and casualty side, they would often want to run 1 million scenarios because the risks they were looking at were so rare, so infrequent, but so humongous. They really wanted to understand that. That's why I brought up extreme value theory. It's that idea of really studying those extreme tails of the distribution, because they're not as narrow and thin as a normal curve would say. There's some bumps in those tails where you see these massive, massive losses that a normal curve would say would be impossible, and yet the actuaries know, no, they're possible because you can have an event that hits just right. So we're going to talk about value at risk. We'll be mainly using parametric in your project. We'll do some historical VAR, and I'll show you in a video exactly how to do that. It's actually something that's not used in practice, but I'm encouraging you to add it to your analysis because I think it's actually pretty eye-opening. And then I'm hoping when you meet with a financial planner and they only show you parametric VAR, that you'll go out and ask them for the historical VAR. So I'm hoping you'll do that. We'll see. I'll show you how to do that. It's fairly straightforward. Other measures that we've seen before, stress tests are obviously a really, really critical one. A stress test is different than value at risk. Value at risk, you actually can state the probability. You have statistics. Stress tests, you don't always have the probability. A lot of times with stress tests, they'll say, let's go back and rerun our business in the 2008 financial crisis. Or actually, I saw one airline, they reran their models with a previous pandemic, and they say and they actually did that for 2020 before COVID-19 would hit the press. They knew there was rumors because of SARS and other things, so they said let's run a scenario of a pandemic. And I saw an article in The Economist. It said, yeah, or no, I think this might have been on Yahoo Finance. They said, yeah, that worst case that we ran with the previous pandemic wasn't even close to what happened in 2020. Obviously, you see the revenues drop 80% or more. That was more than anything they could have thought of. So when you have stress tests, there are no explicit probabilities. They're just scenarios. Often just rerun sometime in history. At least rerun the 2008 financial crisis. In life insurance, they have what they call the New York 7, where they have these 7 interest rate scenarios. No one knows what the probability of any one of those scenarios are, but they're asked to run it against their book of business and go to the regulators and say, hey, here's how we did under these 7. I know that the federal regulators for banks have certain stress tests that they want banks to run. Who knows what the probability of those are? Some people might say, let's run a worst case scenario. And often the worst case scenario is based on like a 2008 scenario. Now maybe going forward, their worst case would be 2020. But as we'll talk about this later with Taleb, the worst case scenario that we looked at in the past, when it happened, the day before it happened, it was the worst case scenario is not as bad as the worst case scenario that you just experienced. So when you run a worst case scenario, it really isn't worst case. If the next time, COVID-19 was far worse than anything we've seen in the past for certain industries. And so if you're using past worst case scenarios to define the future worst case scenario, obviously it can be way off because the history can change. So that's one thing I do not like about stress tests, is there's no true probabilities. So at UTSA, we ran the stress test that I showed you when we did the balance sheet immunization. What if interest rates rise 100 basis points, rise 200, rise 300 basis points? What if they fall 100, 200, or 300 basis points? So we ran those type of stress tests, but we didn't know what the probability is. It was more just to say, hey, we just want to understand how sensitive our business is to these scenarios. And then duration and convexity are specific price risk measures related to interest rate risks. We used duration earlier. We hinted at convexity. We didn't really use convexity. And at banks, it doesn't really make sense to use convexity at banks, but life insurance companies, convexity can be a huge deal. Pension plans, pension liabilities have a lot of convexity, so it can be a big issue there. But banks tends not to be big of it as an issue. We didn't actually incorporate convexity into any of our number calculations. It can get quite complex. That's where I brought the phrase of key rate duration for life insurance companies. They get much, much more precise on exactly where your interest rate exposure is. So what we are going to focus on here is value at risk. And we're going to use standard deviation and our parametric value at risk. And here's the formula that you have to know. Very, very simple formula. The value at risk formula is you take the mean minus the number of standard deviations. So what in the world does that mean? We'll have to look at that. I think I brought it up in an earlier class. 1.64 is 5% event, 2.33 is a 1% event. There's certain number of standard deviations that equate to a particular risk tolerance, and you multiply that by your standard deviation. Now, I use parametric VAR at USAA. The way we did it at USAA is kind of interesting. We might get back to this. But for the catastrophes like hurricane and earthquake, we use stochastic value at risk, running simulation models. And that was such a massive, massive risk. That was $3, $4, $5 billion that we didn't see any reason to get that complex on the investment side. So the investment side, we're looking at a few $100 million types of risks that we just use parametric VAR value at risk there. And I used to tease the poor accountants. They would call me and ask for the standard deviation or the number. They were actually asking for this entire number, but they'd call and ask me for the standard deviation. And I knew that's not what they wanted. And so I would kind of play a little bit dumb. I wasn't being mean, but I was like, my goal was, and it's a little bit of something I hope you'll be cautious of. I knew I had people calling for a number they didn't understand, and they had no interest in understanding it. And it just kind of like, for me, talk to me. Let's learn this. This is an easy part of finance. It's not that difficult. And they just had no interest. They just give me the number, whatever the number is. They didn't know how to ask for the number. They didn't know it was a parametric VAR. They knew standard deviation was in it, so they kept calling me and asking for the standard deviation, but I knew that wasn't what they wanted. But I kept kind of setting them up, hoping they would say, hey, can we sit down and you go through this in detail? But they never did that. I somewhat understand it. It was a very stressed out department because of their exposure with executives, and they had a million things going on. So I couldn't blame them, but I know in my career, there were times where I was like, just give me the number because I was stressed out. But I tried most of the time. If someone's giving me a number and I don't understand it, I'm going to go figure it out. So a simple formula. And we did use this. And the question is going to be, are investment portfolios normally distributed? So we'll look at that. So what this is going to give us is the expected loss at a probability associated with those number of standard deviations. So again, I said a 1% event is a 2.33. You might say it's a 2.33 sigma event. Now we're looking at a one-tail event. Now it's get confusing whether they're looking at two tails or one tail. Remember, we're only looking at losses. We want to know how much you can lose at some probability. So it's a one tail. We're only looking at the left side of the tail, the downside, the negative. You've heard of a two-tail event where you say, if you're plus or minus one standard deviation, you've got 2/3 of the curve. That's two tails. But we're not looking at two tails. We're looking at just one side of the distribution. I'll give you a picture of that. So this number that comes out is going to be the loss that's expected to occur at that frequency, and it's really or more. So if our value at risk is $10 million and our risk tolerance is 1%, then what we're saying is we have a 1% chance of losing $10 million or more. I know I talked about this earlier in the class when we were talking about Project 1. You should have been seeing this in your banks. So VAR is always a positive number. So this formula will definitely give you negative numbers, and it almost will always give you a negative number unless you have an asset that's just, or you're looking at something that just isn't that risky at all. Give you a negative number. We actually state VAR as a positive number. So the better way to say this is the absolute value of this, and that's how we'll state it. So if you get a negative 10%, you don't say that our VAR is negative 10%. If you get a negative 10% with this formula, you say our VAR is 10%. Just like with USAA on the hurricanes, if our hurricane loss is $3 billion, we don't say that our value at risk is negative $3 billion, even though it's a loss. We just say that it's $3 billion. USA doesn't use the term value at risk, they use the term probable maximum loss, which is a VAR calculation, a stochastic VAR calculation that actuaries use, but it is the very, very similar concept. All right, so like I said, with your banks, they're doing this, but probably on a daily basis. Now, one thing to be careful of with a daily basis is that usually on a daily basis, the mean is 0. And some students get really confused on the first exam because I give them a lot of problems, practice problems where the mean is 0, and they get used to doing that. And then I give them a problem where the mean is 8% because I'm using annual data instead of daily data, and some students just absolutely freaked out with that. But it's the same formula. If the mean is 0, then yeah, you just do 0 minus 2.33 times the standard deviation if you're doing a 1%. But if the mean's 8%, you do 0.08 minus 2.33 times, say, 0.15 if the standard deviation is 15%. All right. So if that's 10%, then you say, hey, 1% of the time we expect to lose 10% or more, or I expect to lose no more than 10% 99% of the time. All right. So we express it as a positive number. We'll come back to mitigation. So I'll put this here. We're definitely going to talk this, especially the correlation aspects of it, and risk budgets. So you've probably seen this, or risk limits. We'll come back to this. We definitely saw that when we're looking at JP Morgan. We saw the diversification benefit. And hopefully on your banks, you've searched on the word limits and you see what's going on. But let me just real short in the process. The measure of risk is VAR, value at risk. That's how much we expect to lose or more at a risk tolerance. The mitigation is our risk budget, our risk limits. Again, I think I said earlier, risk budgets is not as well known as risk limits. So, you're probably better off talking limits than budget. Budget was a term that came around probably about 15 years ago, and it looked like it was going to take off and people were going to use it. But there were so many banks and insurance companies using the word limits that they're like, I forget which part of finance discovered the term risk budgets and started using it, but it just didn't take off. So I used to use, I put this word in the notes mainly because it used to be the cool term to use. But the risk budget is how much you're allowed to lose. So if your expected loss at that probability is greater than what you're allowed to lose, then you've got a problem. So here's the process. The first thing you have to do is determine your risk tolerance. Now, I actually give you your risk tolerance on the exam questions. On project 2, you'll have to actually determine the risk tolerance for whatever client you come up with. And we'll see that. I'll show you. For young people, we use a risk tolerance of like 5%. For older people near retirement, we might use a risk tolerance of 1%. So the lower the number, the closer you are to 0, the lower your risk tolerance, the less tolerant you are to risk. So older people that are in retirement, who can't take much risk, they might have a 1% risk tolerance. And younger people in their 20s, most of their wealth is their human capital that we talked about in last class. Human capital, so the portfolio they have is a really small part of their wealth. They can have a risk tolerance of 5% because they can survive those big bumps, and so they'll have much more in stocks. At USAA, our risk tolerance was 0.2%. So USAA's goal was to survive a 1 in 500 year event, and in fact, it even got kind of even bigger than that when one CEO. Our risk tolerance was 0.2%, and after the 0.2% event, he wanted us to still be a very strong company. And then right after that 0.2% event, that 1 in 500 event, we would have a second 1 in 500 event, but all of our hedges would be out of business. Our reinsurance, they'd be out of business. And after that second 1 in 500 event, he wanted USAA to still be investment grade. Not a strong company, but still viable company. That was a very, very, very conservative approach, extremely conservative approach. So I don't know what that actual number comes out. You can't just take 0.2% times 0.2%. As the actuaries pointed out, it was kind of a strange scenario. Why they did it like that is kind of, but that's a really rare event. I know the executives at the time, they could say, well, I could see a 1 in 500 year event happening right after we had a 1 in 500, but the probability of that is 0.2%, because they're saying I can see that happening if we've had the first one. So B given A, if the probability of A is 0.2% and the probability of B is 0.2%, what's the probability of B assuming A's happened? Well, it's 0.2%. What they weren't realizing is these are incredibly rare events. We've not seen one. We've not seen a 1 in 500 year hurricane. They're extremely rare. Katrina was not a 1 in 500. Harvey was not a 1 in 500. I remember Hurricane Andrew. We thought that was a pretty rare event when it happened back in the 90s. And once they refigured their models and reran it, it was only like a 1 in 50 year event. So, so you look at those major hurricanes and earthquakes we've had in the United States, we've not seen a 1 in 500 year event. Now there's a lot about COVID-19 that is a 1 in 500 event, I think, for airlines and cruise lines. Pretty extreme event. But we are very low risk tolerance. So a 1% risk tolerance might be a BBB rated firm. A 0.2 like USAA might be AA rated type of firm. So they're going to have a lot more cushion, a lot more net worth to be able to handle those extreme events. I talked about for individuals. An older investor, it could be really low, like 0.1%. You'll probably on your project will either use 1% if you have an older person, or 5% and you pick your own client. We'll get into that though. So once you have a risk tolerance, then you calculate your VAR and determine what that loss is at that risk tolerance. You then compare that VAR to your risk budget or your risk limits. If the VAR is less than your budget, then you're fine. You could even take more risk. If the VAR exceeds your risk budget, then you have to reduce your risk somewhere. Now the question is, how do we come up with risk tolerance? And financial planners say you do it with risk questionnaires. Some of you that have taken my Principles of Investment class know I hate risk questionnaires. I think they are a horrible thing. So this was the risk questionnaire we had at USAA. I thought it was a terrible one. I went through and I answered it. Every single combination there was. And I actually went online and answered. I guess kept changing my answers. You're going to notice some of these answers, if you say yes on one and no on the other, there's no way that's consistent. And that should flag the system. This person is not understanding the questions, but I didn't do that. The other thing I noticed is a slight difference in my answer gave me a radically different asset allocation. So I asked the financial planners, how do you know this risk questionnaire is accurate? And they were like adamant. They didn't want to talk about it. They said, we did a lot of studies. It's scientifically proven. None of that was true. I knew. There are no scientific studies on this. So I don't like these questions. So let's see what they're trying to figure out. I'm willing to lose money in the short term if I make more in the long term. Yes, no, maybe. I don't know what you do if someone says maybe. I do not panic when stock loses money. Now, how can you say I'm willing to lose money, but I also panic when a stock loses money? How can you answer yes here and yes here? You can notice at least they made it so that the person, it was worded differently. So here they should say, yes, I'm willing to lose money, and no, I don't panic. So if they answer yes and yes, you've got a problem, but the system didn't flag that. I am an informed investor and stay current with economic news. There's no, how do you know who that is? I've got a graduate degree in finance, and I was managing billions of dollars. I would answer yes. Someone else who reads the Wall Street Journal every few weeks, they might answer yes. What's the gradation here? Is it possible one person would answer it yes who knows very little about markets, and someone answered no who knows a lot about markets, but the first one thinks they know a lot and the second one doesn't. So this is a very subjective, their opinion, based on what benchmark. And then how many years until you expect to retire? So there's the most important thing right there, which is horizon. That's the only one I think that actually works. The reason I hate these is these first two questions. You asked this question in 2007 when the stock market has been up a good 6-7 years and is doing great, and people say, yeah, I'm willing to lose money. No, I don't panic when stocks crash. You asked this question again in February of 2009 after a major stock sell-off, when the stock hit its bottom, just down over 50% from its peak. Then there they might say no and yes. And so if you look at a risk tolerance questionnaire, people change their answers to these questions based on the market they just experienced. And the worst thing is they do it in a way that harms them tremendously. So after the markets have been up for several years, probably a good time for you to cut back on risk. That's when people answer these questions the most aggressively. And so the model puts them more heavily in the stock. So when they probably should be cutting back on their stock allocation, these risk questionnaires actually get them to increase their stock allocation. And at times where the markets just crash, that's when they'll answer these more conservatively. The model will actually reduce their stock allocation. So at just the time they should be probably increasing their stock allocation, the risk questionnaire says to reduce it. So risk questionnaires, in my mind, because of the biases and the psychology of the people answering them, they tend to have people buy high and sell low, and I just do not like them. Other than the horizon question, I do like horizon questions. Now, before we're going to work some examples on the value at risk, just give you some practice. Before we do that, though, I want to talk about the normal curve. And I want to give you two examples, one from the stock market, one from the bond market, and it just makes everybody's really comfortable with the normal curve. So we're gonna detour here over to Excel. So let's start with just a reminder on the normal curve. So I just copied this out of a Google image. So this is a two-tailed test, but that's okay. So the mean is right in the middle. Notice how nice and symmetrical this is. So one standard deviation, about 2/3 of the curve will be within one standard deviation. Two standard deviations about 95.5, and three standard deviations about 99.7. This is probably the way you saw it in statistics. We're actually just curious about one side. So we're going to do one side of this curve. And let me set this up. And so what we're going to do is we're going to start in the corner here at 0. And then we're going to go up by 0.1 on down here, and we'll go down to 8. I think Bill Gates will go as far as 8. And somewhere 8 something. I'll go to 9. It's somewhere he gives up around 9. And then across the top, we'll go up by 0.01. Now, what does that mean? So let's start right in the middle. We're going to use the function equal norms dist, and then we'll do the number of standard deviations. So let's start right here. So equal norms dist, and we want to take 0, and I want to lock in the column A, plus 0, lock in the row. When I hit enter, I should get 50%. Now, why is that 50%? Well, if you're right at the mean and you don't move left or right, how much of the curve is to the right? Because we're going to the downside. If you have 0, you're right on the mean, then 50% is to the right. All right? What if we do 1.64? Remember that 1.64? There's 1.64 right here. 1.64. Remember I said that's 5% or 95%. So this is telling me the 95%, of 1.64 right here, what that's telling me is about 95% of the curve is to the right of 1 standard deviation, about 5% is to the left. And then remember the other one we did was 2.33, and that gives us that 1%. So 2.33 are right about here. To the right of that is 99%, and to the left of that's 1%. Now 3 standard deviations is 99.7, but that's, you've got 0.15% over here and 0.15% over here. So we're just looking at this side over here. And so when we look at these numbers, it's telling you how much is to the right of that line. And so we're looking at the left of that line. So 1 minus what's in this table is going to give us our probabilities of these events. So let's copy this all the way down to 9. Let me lock in the frame so you can really see it. So this is, we're going to use a normal curve. I'm going to give you, on project 2, I'm going to give you a slightly different formula that it actually gives you the probability fairly well. But 1 minus this is really what we're interested in. So whatever's in this table, 1 minus, that's what we're looking for. So when we said 1.64, that's a 5% event. It's really between 164 and 165. So somewhere between there is our 5% event. And then 2.33, that's a pretty good job of getting us 1%. I remember having a stats professor who required us to interpolate between these two and to get the exact number, 1.6456321 or whatever. That's just ridiculous. We're just gauging it. Our numbers are not that precise. If you have a professor that ever has you interpolate the normal curve, you just got to say, my word, are you kidding me? And plus, you don't need to. There's a formula that if you plug in the probability, the 5%, it will give you the number of standard deviation. So I'll show you that formula when we work on project 5. But I just want to show you the normal table. So if someone says, hey, we have a 1% risk tolerance, then you're looking at a 2.33 standard deviation event. 2.33 standard deviations equates to a 1% event. So 1 minus whatever's in there. 1 minus 0.99 is 1%. And then the other one we have is the 5% event. 1 minus 0.9495 is about 5%. Somewhere between there and there. And there was a bunch of others. You notice as we go down, it looks like there's nothing there. So, how many decimal places do we have to go to get a number there? There is a number there. So, at what point will it not show a number anymore? And it's somewhere in the 8s that it will stop giving you a number. So somewhere in here, somewhere in the 8s, Excel gives up and it says the probability is 0. But yeah, we have, there are implications. I'm going to show you some applications where we're more than 9 standard deviations away from the mean. So so anyway, that's the analysis. As we saw here, this is a 2-tell test. And so if you look here, 95.5, what's that saying is the two sides outside of that should add up to 4.5%, which means you need 2.25% over here and 2.25% over there. So if we go 2 standard deviations, 2 standard deviations gives you a probability of 9972. So 1 minus that is about 2.25%. So I couldn't find a 1-tell graph to show you here, so we're doing 2-tell, but that's where we're, that's what I have available from the internet as a photo of this. So hopefully the normal distribution makes sense. We'll get a little more practice in this definitely when we go through some problems. So I want to do an actual example here from real life where we're going to look at two markets, the S&P 500 stock index to look at the U.S. stock market, and then 10-year treasuries to look at the U.S. bond market, just to give us some sense of what this analysis means. So what we're going to do is we're going to do the daily return of the S&P 500. So we'll take the ending S&P on January 2nd, 1945, divided by the last day of 1944, minus 1, and that tells us that the S&P was up 38 basis points. I went back to 1944. I could have gone back to the 20s, but I want to keep the Great Depression out of here because it really skews the numbers. I'll copy that down, and so now we have our daily returns. I'm going to go to the bottom of this. I did this through January 22nd. So let's look at some numbers. Let's first look at the average. This is what I was talking about, the average of the mean. If you do daily numbers, it's going to be somewhere pretty close to zero. I think about 3 basis points is what I remember. So yeah, the average S&P is your best guess for what the stock market's going to do next day that the market's open is probably 0. You know, slightly positive 3 basis points. But, you know, 3 basis points times 250 days in a year of trading gives you about 8.6. That's about right. That's what our stock market does. And let's do the standard deviation. So I'm going to use the equal STDEVP, the population one. We'll do that. And this is a nice, really wonderful number. It's right at 1%. So it's really easy to remember. And so, you know, just remember that a 1% day in the stock market, positive or negative, is a pretty big day. Now, I want to just remind you, let's do this manually. So how do we do this manually? So remember the formula for standard deviation is x of I minus x bar. We square that, take the average, and then we take the standard deviation, the square root, sorry, take the square root of that. So let's try that. So xi minus x bars, so there's xi minus x bars, so we've got our average down here. And we take this, we square that, we copy that. I'm sorry, here it says divided by 2. Sorry, I'm hitting all the wrong numbers. So we take xi minus x bar squared. We take the average of that and take the square root. So we've got the first part of this, xi minus x bar squared. We're going to copy that down and then take the average of them. So we're going to take the sum of all of this divided by n, or the average, and take the square root. So you do equals sum of all of that divided by the number, the count, and we'll take that and take the square root, and there's my 99. So I strongly recommend you do this in Excel. Manually do these formulas yourself and see if you can get the same answer as Excel. You should know these formulas backwards and forwards because there's so much financial theory in these formulas. And finance, how do we define risk? It's how far can you be from the expected value. Now here we're assuming a normal distribution. If distribution is not normal, then this formula is going to give us bad information. And we'll see that here in a second, that it can really be misleading if the tails are thick or wider or thicker than we think. But it gives us some sense of risk. And so let's do some math on this, all right? So let's take each one of these. I'm going to take this formula out. We don't need it. I just want to double check that we could calculate standard deviation. So let's take each one of those, and we're going to take the absolute value of January 2nd minus the average. That will tell us our difference from the mean. And then I want to know how many standard deviations is that. So I'm going to divide it by my standard deviation. And so that first year, that first day, This is a 0.35 standard deviations. How often does that happen? I'll take 1 minus norms dist 0.35, and that happens about 36% of the time. What does that mean? 36% of the time we would expect a daily return of 0.38% or higher. So about a third of the time we expect, remember the mean was 3 basis points, so 50% of the time we expect to be above 0 or above 0.03%. 50% of the time we expect to be below 0.03%, but 36% of the time we would be expected to be above 0.38. So we can copy that down and we see these probabilities, pretty high probabilities. So here's a pretty extreme day. The market fell 2%. So only one day out of 100 would you expect a 2% drop or more. So in a year, there's 250 trading days in a year. You might expect 3 or 4 or 5 of those. I remember, I think it was, I can't remember what year, of 2017 maybe. We didn't have any years over, we didn't have any days over 2%. So pretty tame, calm years. So you can just see there's a few low probability events, but nothing real radical. Here's one right here, 2.93. In a year, you might expect to see half of one of those. And in 10 years, you might expect to see 4 of those. So let's jump down to 2008. Or jump back up to 2008 here. And we'll see, so Lehman went under. Get rid of some of these. Lehman went under around September. So let's see if we have some big days in September. So there's a day right there, minus 3.41%. How often does that happen? We'll multiply it by 250 times 10,000 years. So how many days out of 10,000 years would we expect? About 605. So that's a pretty big day. Here's a whole week. That first one right there, that day, and that day we would only expect 2 days like that out of 10,000 years. Not 2 days out of 10,000 days, but 2 days out of 10,000 years. So pretty rare event. So that was a pretty wild week right there. Look at this day. So right there, that 8% on September 29th, we're getting real. So Lehman went under on September 15th. So that weekend, so the market definitely dropped again, came back, dropped again. And so, yeah, Lehman got this started. You can really see the volatility really picking up that weekend after Lehman went under. So, yeah, I mean, that's a pretty wild 2 days there. Down 8%, that's impossible. And here it says 0. Remember, that's 0 days out of 10,000 years. Out of 100,000 years, you would expect 1 day like that. We had 2 days in a row where we had that. And then just a couple of days later, we had something pretty rare. And then you get down here, we had an 11% day. I don't know what happened on that Monday, but an 11% day. But then 2 days later, a day later, a day later, a day late, a few days later. Look at that. There's another impossible day. Then you get in November. Boy, I remember this week in particular, because this Friday, November 21st, I can't remember exactly the date though. I remember I had a big meeting on the 21st. I had another one with the CEO sometime during this time, but I just can't remember when. We were hedging our stock portfolio, and I went in with the argument, let's take the hedges off. And we were down about 9% on that day. And my boss was upset because we were down 9%, even though the market was down close to 50%. So he should have been happy with -9, but he didn't want us to lose money. So we go to the CEO and say, hey, we've been hedging. It's greatly reduced our risk, but we do have a loss. But the market is down so much, I want to take the hedges off. And the market actually, and he was fine with it. My boss was kind of panicking, but our CEO was fine with it. So we took the hedges off. That was actually the reason I know it was somewhere around here. It was on a day when the options were expiring. So I think it was, I get some of my dates mixed up between this and when we had our meeting on the pension plan. But so there's there's the date where we said let's take the hedges off, and the market went up 10%, so we actually ended the year with a positive 1% return. So that was a big day, but you can see how nervous I was. If that was a date, I say let's take the hedges off, and then the market falls 9%, but the market did come up pretty strongly. And I think that's about as bad as it got. The rest of the year, we had a few big days. Remember, the bottom of the market was right here, 676, March 9th. That's as low as it got. But December, it had risen quite a bit. You can see it got up above 900, whereas only at 800 here. So it's a pretty good rally in December. And then it sold off again and got down to, March 9th, got down to 776, or 676. I always remember that number. So that was the bottom for the market. And then it just took off after that. Just amazing rise. Then we get to 2020 and COVID, and look at this few days right there. This week right here is actually more volatile than anything we saw in 2008. Those few days were just absolutely crazy. So we had a couple weeks there where were not as volatile. I found a week during the Great Depression that was more volatile than this, but it was just, COVID was really out there. So people think about the financial crisis of 2008, of really volatile stock markets, but we actually saw more volatility a few weeks in 2020 with COVID-19 than we actually saw in the 2020 crisis. And you can see it way back, several 4% days, all in a row out of 10,000 years. Just, you should only see a few days like that. Then it started settling down a little bit. You got a 5% day here, but pretty calm relatively the rest of the year, with a few bigger days, but nothing all that radical. So most of it was right at the start of COVID. So there's a stock market. So let's jump over and talk about the bond market. So what does this tell us about the stock market? Well, before we do that, let's look at 1987. So you may have heard of Black Monday, 1987. The market fell 20.5%. That's a 20 sigma event, 20 standard deviation event. We can't even do the math on that. I don't think. I guess there's some computer out there that can go out enough spaces to give you the probability of that happening. But I mean, that's essentially, you're leaving your house, and when you step out of the house, you get struck by 3 rattlesnakes, even though there's no rattlesnakes in your area. And while you're trying to run to get to the hospital, you run into a polar bear, and the polar bear takes you out, and while you're falling to the ground, a rabid dog bites you, and when you hit the ground, you get struck by lightning, and then a few minutes later, a plane part falls out of the sky and hits you in the head. It's that kind of probability. All these completely unrelated things all happen at the same time, just completely unrelated. The polar bear is not there because the rattlesnakes are there. It's just the polar bear escaped from the zoo and just happened to come to your house. At the same time, some rattlesnakes decided to come out of the countryside. It's just, that's the kind of craziness we're talking about. So you might ask, well, was this really that rare an event? Something that would only happen one day out of a trillion years to the trillionth power, or whatever it is. I have no idea what the math is, but something that's just completely unheard of. And most people say no, there was this was more likely than what our statistics say. So there's something going on with stock markets and the tells that give us more extreme events than would be expected by normal distributions. And yet most of the financial planning community uses this type of parametric value at risk, where they're using standard deviation and means to try to tell you the probability. That's why in Project 2, I'm going to have you do a parametric value at risk and a historical value at risk, so that you can see that the parametric value at risk does a good job of explaining risk, except for at the extremes, which is when you're most concerned about it. Now there's stock markets. So let's talk about bond markets. So I got this stock market data from Yahoo Finance. I got the Treasury data from Yahoo Finance. So here we want to look at the change in basis points. Remember that basis points is the change in the interest rate times 10,000. So here interest rates fell 3 basis points. So I'll copy that down. So again, we want to do the same thing we did before. So we want to do the average. Now here the average should be negative because interest rates were 1% when I did this, and they started at 4%. So obviously if we go from 4% to 1%, the average will be negative. But it's not all that negative. It's only 0.02 basis points, so it hardly even shows up. The standard deviation this is an important number to know as well. It's about 7 basis points. So I've given you 2 really great numbers to know. On the stock market, the daily standard deviation of stock markets about 101%, about 1%. The standard deviation on the bond market is about 6.5 basis points. So I would just memorize those 2 numbers. What is a big day on the stock market? It's plus or minus 1%. What's a big day on the bond market? It's 6 to 7 basis points. You can see we haven't had, there's kind of a big day there. That's back when we had the Capitol riot day. I don't know if that's why the bond market was reacting, because the stock market hardly moved on that day. There may have been something else going on. But yes, that's a little bit more than one standard deviation event. But if you go back to COVID-19, again, COVID-19 gave us some of the most volatile bond market. Let me take this stuff out. Sorry, I had some extra stuff in there. So back to COVID-19, you'll see there's a 17 basis point day. There's a 22. So let's look at the 22. So you take equal absolute value, the 22 minus the mean. Remember, the mean's close to 0. And we divide that by the standard deviation. So it's a 3.37. So what's the probability of that? Equal 1 minus norms. Hopefully you're getting used to what I'm doing here. Norms dist. We'll do that times, do that in whole thing times 250 days. Times 10 years. I'll do this out of 10 years. You might see one day like that out of 10 years. I think that was one of the bigger ones. I don't think we saw anything much bigger than that. So yeah, that was a big day. So 1 out of 10 years, you should see that. We saw 2 days in a row. We got 2 days in a row. We saw something we should have only seen 3 days out of the last 10,000 years. But in the same week, well, Friday and Monday, we saw, and they are both down. And this date right here is an incredibly important historical date. This was the first day in the entire history of the 10-year Treasury for it to fall, the 10-year Treasury to fall below 1%. And then here is its absolute low for closing. I think intraday it might have gotten lower, but closing, that's the lowest the 10-year Treasury ever got. You can see what COVID-19 did. It's just the market just in a few days. We started the year with the 10-year Treasury getting close to 2%, 1.9%, and in just a few weeks, it was down to 50 basis points. That's a pretty dramatic drop in interest rates. So I'm giving you some data. If you think, I've done a couple of things. First, I've given you the 1% and the 6.5 basis points to give you a good basis for what's a big market. So if you're interviewing for a job and you see Treasury yields are up 10 basis points, that's a big day that you should talk about in the interview. If yields are up 1 basis point, it's not a big deal. If you see the S&P 500 is down 1.5%, that's a big day and you want to talk about it. So it gives you something to work with. Also, what you're seeing is that the normal distribution does a great job of explaining the risk of stock and bond markets, except at the extremes. When you get an extreme year like 2008, like 1987, like 2020, normal distributions grossly understate the risk. But financial planners use this stuff all the time. So, what do we do with that information? We know they're using it and it doesn't work when we most need it. That's something you'll have to decide. Essentially what the finance planning community says is, yeah, we saw something in 2020 that we thought was mathematically impossible. Saw something in 2008 that was mathematically impossible. In 2000, we saw some crazy times, 87, 73, 74. We're just going to assume those will never happen again, that those were outliers. But they happen, every 5 to 10 years. We see something that is far outside of the bands of what the normal distribution says. Now, what I want to do next class, I wanted to go about 70 minutes on here. I'm not sure exactly how much time I had because my clock kept getting messed up. So I'm not sure exactly how long this video is, but I'm shooting for about 70 minutes. So I want to stop here. But what I want to do next class is I want to show you how I use this data from the 10-year Treasury to calculate the potential exposure for the counterparty risk that we talked about when we were talking about the interest rate swaps. So I want to show you a way, even though we know there's a little bit of uncertainty here that you can get into a market like 2020, I'm going to show you how you can still use this data to come up with at least a basis for understanding what your risk is. So we'll start there in our next class and give you a powerful tool that you could actually use in one of your first jobs.